Welcome back. Earlier today, the S&P Case-Shiller Home Price Index was reported. On all accounts, it looks like a positive number. Home price index of 0.65% on a month-over-month basis, year-over-year up 3.9. Same holds true for the 20 city home price index, all transactions up 4.8. What we're going to see, though, in just a moment is that, while the home prices are rising very slowly, we can take a page out of history to see what might spark a big change. We're going to get to that in just a moment. Top center, all transaction house price index. These are the actual figures released, 657. That's at a constant for the past few months. The home price index, bottom left, continues to rise, as does the 20 city home price index. We won't see much of a divergence here. Now we see here the home price index on a year-over-year basis in green, rising, after hitting pretty much negative territory just a few months ago. The white line is a 1-year U.S. Treasury bond that's in yield. The red line is a 10-year. We still have very much an inverted bond market where the 1-year is very much ahead of the 10-year. And this is measured, on a month-over-month, year-over-year basis. Obviously, when the home prices hitting their highs back in the 2021, 2022 area, that coincided with a rising 1-year treasury that coincided also with the rising interest rates. Now, of course, the higher interest rates certainly have quelled a lot of the growth. It looks like we're coming back, though. It looks like that the home price index is trying to fight its way back into positive territory despite higher rates. But again, what we're going to see in just a moment is that I don't think we're going to see any big moves under current conditions. Here we see the home price index in red versus S&P 500 in blue. The stock market lately has been quite a bit stronger than home price index, given their historic positive correlation. The question is, will stocks go down and meet the home price index, which is much lower, or will the house price index really return up to lofty levels? Here is a home price index year-over-year basis in in red versus federal funds in blue. Obviously, low interest rates certainly create the ideal climate for the real estate market. Higher rates have pushed us down. Maybe the housing market is starting to fight a little bit of a recovery back higher in anticipation that the Federal Reserve may be done raising rates. At least that's what the Fed funds futures are telling us. However, despite that, it's going to be a long time before we see much lower rates down to where we were, in the 1%, even lower area just a few years back. Compare the Case-Shiller year over year on the left-hand side. This is 2006 through 2011, hitting negative territory early 2007, reaching lows negative 12% at this point. That was late '08, early '09. Now, we did cross very briefly in the negative territory just a few months ago, but it seems to have bounced back to the upside. So the question is, where do you think we are? Are we at a point where this is just a blip and we may continue lower like we did in '08, '09? Or is this really a shallow, soft recovery and we may see a bounce from this point moving back up higher? But here is a real question because, we hear about the lock-in effect all the time. And that's the phenomenon when we have very low interest rates followed by a very rapid rise in interest rates. The black histogram bars over here show us federal funds rate, which as late as early 22, it's about a year and a half ago, believe it or not, we close to 0% interest rates. And in the past year and a half, we go from 0 to 5.5%. And that lock-in effect, essentially what it does is it dissuades sellers. Because if I have a house and I want to sell it, well, I know I'm going to have to take out a mortgage on a new house, and that's going to lock me into higher rates. So a lot of potential sellers are saying, no, I'm not going to sell. So now the question is, will sellers be brought to the market if rates come down? We'll take a look at what happened in 2019. It's certainly not a comparison to where we are now as far as rates are concerned. But we did have, just a hair under 3% interest rates 2019. Interest rates started to decline. But notice the home price index was actually almost completely horizontal. It didn't move for about a year or so, not to any great degree. It seems that maybe the sellers at this point were waiting for lower rates because, well, we didn't know what was going to happen. But at this point, 2.5, 275 on interest rates probably felt pretty high. And that eventually, when rates did come down, that's when the sellers came in, but that's when really the buyers came in. So the question is now, with currently 5.5% interest rates, let's say we move forward 1 or 2 years from now and we see rates come back down to 1%, as an example. Well, what will happen? And this is really an open-ended question. Let us know what you think. Is this going to be the situation where the sellers rush to the market first and push the Case-Shiller Home Price Index much lower? Or will the reverse happen? Will buyers rush to the market first and say, I want to buy a house? The stock market has already gone up a lot, but now that home prices, I think they're going to go up, and now lower interest rates are back. So the question is, if we see lower rates, dramatically lower rates in the next, let's say, 12 to 18 months, who do you think is going to rush to the market faster? The sellers or the buyers? And I think the answer to that question, which only the market can ultimately tell us, the answer to that question will determine whether we have a housing crash, another bull market in the housing market, or maybe, somewhere in between. Let us know what you think. We hope this has been helpful. We look forward to seeing you back soon.